Have you ever looked at an investment you sold, watched it keep climbing, and thought, if I just waited a little longer? Why does selling too early often leaves a deeper emotional scar than holding through a temporary loss? And what does that reveal about the psychology of investing?
I think almost every long-term investor has a story like that. It's rarely the investment you held through a bad week that stays with you. It's the one you sold too soon, only to watch it double, triple, or become something extraordinary. What's fascinating is that the money isn't always the biggest loss. The emotional cost is. When we sell early, we're usually trying to escape uncertainty. We tell ourselves we're being disciplined. We lock in a profit, feel relieved for a moment, and convince ourselves we've made the smart decision. Then time passes, the asset keeps growing, and relief quietly turns into regret. That's because our brains don't measure outcomes objectively. They compare reality with what could have been. The gap between those two becomes emotional pain. In behavioral finance, that's one reason regret can be more powerful than the joy of making money. Imagine planting a mango tree. After a year, you see a few healthy fruits and decide to cut the tree down because you're happy with what you've harvested. It sounds ridiculous, but investors do something similar all the time. They sell a quality asset before it has the chance to become truly productive. The fear behind it is understandable. Nobody wants to watch profits disappear. Markets move up and down, headlines create anxiety, and every dip feels like it might be the beginning of something worse. But building wealth has never been about avoiding every uncomfortable moment. It's about learning which discomfort is worth enduring. I've noticed that successful investors often share one quiet habit. They spend less time predicting tomorrow and more time evaluating whether the original reason they invested still exists. If the business, the opportunity, or the long-term thesis remains strong, they don't let temporary emotions make permanent decisions. That's not the same as refusing to sell. Sometimes selling is exactly the right move. The difference is intention. Selling because the facts changed is very different from selling because your emotions became louder than your strategy. One of the greatest opportunity costs in investing isn't losing money. It's interrupting the power of compounding before it has time to work. Great investments often spend years looking ordinary before they become exceptional. Patience rarely feels exciting while you're living through it, but it's often what separates average outcomes from extraordinary ones. The next time you feel the urge to sell, ask yourself one simple question. Am I responding to new information, or am I reacting to temporary emotion? That single question can protect not just your portfolio, but your peace of mind. Because in the end, wealth isn't built by making perfect decisions. It's built by making thoughtful ones consistently, even when your emotions are asking you to do the opposite.
That was a powerful reminder that investing is as much about mastering ourselves as mastering the market. If this conversation made you think differently, share your biggest investing lesson in the comments. Subscribe for more insights on wealth psychology, and I'll see you in the next episode.